Stagflation. That is what this week will be all about with the CPI inflation report coming out on Thursday morning. And I'd love for there to be a tradable blue sky breakout prior to this release, especially on the heels of Friday's massive labor report beat, but the buyers still have some work to do. So welcome to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we've got a green-bodied hammer. And we should talk about location here in tandem, because to produce the lower wick, we know that the sellers applied some pressure, and we actually made a bar-to-bar lower low. But put yourselves in the shoes of a seller. Is this the ideal weekly close? Absolutely not. After you breach the low of an inverted hammer in terms of the previous week's structure, ideally the sellers would have accomplished a close underneath the previous low. Now, we all know because this is a hammer, the buyers respond off the lows of the weekly range, move to the opening print through the opening print for range expansion because we do have a green-bodied bar, and we close in the upper third of the weekly range. This is absolutely way more bullish than it is bearish. This is actually a failure of the sellers to produce any meaningful downside. And mind you, all of this is happening above the weekly breakout level. We had previous resistance, now starting to act as support. It's also happening well above the anchored VWAP cluster. The anchored VWAP from the previous pivot low, we're well above that. If we take a look through the lens of Fibonacci using that same pivot low to the all-time high, well above the Fibonacci 38.2, classifying all of this as bull flag consolidation. And what about the volume profile? There's actually a pretty interesting nuance that I want to point out here. Let's drop this to about a 6-month chart, and we'll take a closer look. Here we go, zooming in. Notice that the low of this high volume node is the low of the inverted hammer in the previous weekly bar. We looked underneath, meaning that it was very possible all of this could have acted as overhead supply. But where did we find support? Off of the high volume shelf, and where did we close? Well above the bottom of the high volume node, which we had breached in the earlier stages of the week. So absolutely, on the weekly chart, the buyers are in control here. Now, if you've been tuning into the channel for the past couple of weeks, you know that one of the concerns we've had here is the possibility of a look above and fail. Breaching this level, turning previous resistance, not finding support, but rather finding resistance underneath for a weekly trend reversal. While this is still technically possible, anything's always possible in the market, after the structure and location, basically everything we just talked about after last week, the odds of that look above and fail coming true, to me, are dramatically reduced. Let's take a look now at the daily time frame chart and see what's going on from this perspective. We'll firstly evaluate this week's expected move. Bear with me as we get that on screen. Here we go. There's the expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 583.19, implying a massive higher high in the trend count. It's a brand new all-time high. And if we're contained by the lower bound, the number's at 562.80. And unfortunately, that actually does suggest a lower low in the trend count and a move underneath the weekly breakout level here. Those numbers, by the way, down here, that weekly breakout, 566 down to about 565.25. We've been using a little bit of a zone. So the expected move probably leans more bullish than it does bearish, but there is some slight expectation that it is possible to breach that key support. Let's lean back on the classics of technical analysis. What's the trend here? We have lows, soft higher lows. There was no hourly downtrend. This absolutely is a firm higher low. We had pulled back from the highest high in the trend count. There was an hourly downtrend. This 100% is a higher low in the trend count. And as of Friday's close, we're very close to the equal highs. And I want to talk about these equal highs in the same way we did on Wednesday's midweek video. This is the improper end of the auction, where all of these equal highs really don't suggest any sort of meaningful excess at the all-time high. The auction ended improperly. So on the daily chart, if we could get consolidation here that tests 574.40, basically the all-time high shelf, I would be expecting a break on the first go-around. And then from there on the daily, it just becomes a matter of, do we find acceptance above 574.40, or do we promptly come back down? And when I say come back down, the worst thing that could happen here would be a lower high underneath 572. This would be a detrimental outcome, I would say, on the daily time frame chart. Why is that? Because Friday technically opens on a gap up. Let's talk about Friday's structure now, right? We open on a gap up technically outside of this as a daily balance range. So the fact that we closed the gap, but then into the afternoon are able to close back above 572 means that if progress is going to be confirmed in the upward direction, we probably don't want to see prices trade back down under 572. So the simplest pathing on the daily time frame chart, which is really going to carry forward to the hourly as well, looks like bullish consolidation here. Brigade bolt for a bullish breakout into blue sky territories, absolutely. If this fails back into range, I really wouldn't like it. So here's the deal. This, of course, is a path all by itself, right? That is bullish for upside. If we get a breakout that goes over 574.40 and then comes back down underneath 572, this is probably a short right here if we've put in an excess high. Notice that there's a very specific sequence in that particular path. If we just get straight up dribbling down, nonsense move back into the range under 572, I'm not convinced that you want to be an aggressive trader in this box. I mean, let's just ask the question. Has anybody been having fun inside of this box as the market's been grinding around, producing nonsensical intraday moves? I don't think so. So for me, as we head into the week, I'm really reserving the bearish tone for either the excess high that fails back beneath 572, once again, that's this path right here, that, or this is nothing. This is consolidation, let it be. If we slip underneath 566, 565.25, this right here, that's where I would say, okay, I'm very concerned about potential bearish outcomes. We'll use a nice red dot here to illustrate that. So this is really echoing the same sentiment of the Wednesday video where we said, hey, it might look like buyers are failing up here, but there's nothing to do on the short side until you actually breach this level with a lower high. All right, so that is your daily pathing. That's the analysis here. It looks like the buyers are building a little bit of that edge with the close over 572 into the end of day on Friday. Let's take it down to the hourly time frame chart. A couple of things I want to make note of. Number one is that based on Monday's, I shouldn't say Monday's failure, but rather Tuesday's failure to hold cleanly over 572, I would prefer to see some kind of hourly higher low consolidation over 572 to really confirm that this is going to be a successful attempt in the upward direction. Remember that on Monday, we squeezed into the end of quarter, end of month, whatever you want to call it, markup or not, doesn't matter. But we opened on Tuesday over that level and did not find any buy-side pressure on the retest of 572. So do I want to trust it this time around on a V-shaped recovery here? Not exactly. I'd prefer to see this consolidation, and once again, the bullish path looks something that looks like this. I would also say, obviously probably more bullish, would be an opening drive that can also find a higher low up and over 574.40. We're trading into blue sky territories. Remember that in this box right about in here, be my guest if you want to get chopped up, if you want to get chopped up, if you want to get chopped up, chopped up, chopped up. I'm really not interested in it, right? It would have to be an attempted excess high, so consolidation that breaks, then comes back down underneath. If that's the case, I know I might sound like a broken record, but I want to be extremely clear about the outcomes, right? That is where I would entertain shorts and maybe look for a range rotation to the lows. But really, the sellers probably have their edge if we get consolidation and then a break, lower high underneath that zone for continuation in the downward direction. You're probably looking at a weekly pullback in that circumstance, right? So 566, 565.25 still remain as key levels. Let's quickly take a look at the intraday anchored VWAPs, and then we'll move along to the market internals. We did close over the entire cluster. This is your all-time high anchored VWAP. As long as we're above them, again, it probably makes more sense to be bullish leaning than bearish leaning. And if we start to drop this one, which really comes from the pivot low, you can see from back over here is up here. That's where we say, okay, bears have the complete breakdown and overhead supply with the opportunity to move markets in the downward direction. Let's take a look at the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. In the intro, when I had said that the buyers still have some work to do, it's not only what we just saw on the hourly chart with needing to see a higher low over 572, but take a look. I mean, throughout the duration of the week, most of the volume flows were net negative. And into the end of the week, we did get positive, but not substantial here. I'll give credit where credit is due. This is a nice build out of what we saw on Friday, largely due to the gap up. But as we take a look at all of the other indications, it's really not that great. I mean, the advanced decline line is positive, but after a pretty substantial gap up on the labor report, you'd think that there could have been some activity in trend higher zone, simply not the case. If you look at the index score, it's negative all day long. There's no positive build there on the index score. And what about the cumulative tick on Friday? Certainly negative. At the exchange level, it's not really like you had this huge amount of euphoric buying pressure as that gap up took place. So I'm still not convinced that we just want to be like second mortgage the house. It's got to go to all-time highs. Things are looking good. We have closed outside of that hourly balance range. We've closed over that 572 that we were just harping on and on about. But even at the exchange level, there's still some progress that could be made. Things could have looked better than they did on Friday's session. Let's take a look at the market profile. If you're not familiar with this type of chart, check out the video tutorial in the top right-hand corner. And what do we see here? So we really want to focus on the Thursday value and the Friday value. Certainly migrated in the upward direction, the point of control, absolutely migrated in the upward direction. But something that we have to remember is that Friday was a gap up. Why would you want the value to be overlapping inside of the Thursday range? Why would we want the point of control to be directly at the Thursday high? Again, I'm not trying to make up bearish arguments, but it's just not as good as it could have possibly been. The best advance here on the gap up would have been a perfect gap fill reversal, not spending any time inside of Thursday's range. Value builds out higher, point of control is cleanly higher, setting up the breakout for blue sky territories. So when I say that the buyers still have work to do, this is exactly what I mean. Not everything is as perfect as it could have been, but the bulls definitely have some sort of edge here as we're trying to move towards and through the upper bound of the daily balance range. Let's get back on over to the platform. We'll take a look at the QQQ NASDAQ 100. Just bear with me as I reset this chart to a weekly, and we'll go to the NASDAQ clean drawing set, and what do we see over here? So very similar, where we have ourselves, in terms of structure, a hammer candle. We've also got the lower low on the bar to bar count, a little upper wick there. Lower low on the bar to bar count, but closing back inside the previous week's range. And also, we've closed back over the neckline of what could be considered a bit of a double bottom. Recall that on the weekly chart, we need to see price acceptance remain above this inflection point right here if we're going to be optimistic about the S&P 500 continuing in the upward direction. So I like the fact that in the NASDAQ, the lower wick did use the neckline as a new area of potential support. Let's quickly check in on the anchored view apps from the weekly perspective, still staying above the entire cluster. I like the fact that the lower wick is very close and did use that as support. If we bring out the Fibonacci's from the pivot low up to the most recent swing high, not an all-time high in the NASDAQ, but we did stay over the Fibonacci 38.2, which is bullish. And if we quickly check in on the volume profile, what else can we learn here out of the NASDAQ? Let's go with that 6-month chart again, and we'll see what it's telling us. So a close that's actually right at or slightly above this high volume node. The point of control, based on this time period at least, is right here where we did find support. The highest volume node is right there. So I do like the close in the upward direction. And once again, if this can resolve as a bit of a double bottom, and if we can stay over this neckline, which is aligning with the volume node that we see here, that absolutely leans a little bit more bullish than bearish. I would really fall back on the analysis of saying, hey, this was a bearish inverted hammer in the previous week. We technically breached the lows, and the sellers found no continuation in the downward direction. The buyers have a little bit of that weekly edge here. Ideally, the NASDAQ would start working its way back up towards the 500 psychological number, which of course is the all-time high as well. Let's drop this back down to a daily time frame chart. NASDAQ weekly expected move. What do we see here? This is the box. The upper bound is going to be at 498.07, implying a pivot higher high. That is bullish. And the lower bound is almost spot on with 477. It's 476.61. And that would imply an equal low on the daily time frame chart. So the expected move is slightly more bullish than what we saw in the S&P 500. If we're thinking about the trend count, you have lows, higher lows, soft higher lows, firm higher lows because of the hourly downtrend, and now we're starting to move in the upward direction. It's a very classic sort of indication. Would just be taking out a trend line like this. You've closed over that trend line as of Friday's session, and most importantly, you've closed back over this box from back here, which was acting as support, right? You had resistance. Resistance acted as support once, twice. Monday, we tried to hold above. Now it's with the close back above, a little bit better of a look here being up and over this 486 level. As long as we can stay above that on the daily chart, I would tend to think that the buyers are building a little bit more of an edge. If you think about this from a pattern perspective, if the sellers were really going to make something happen, you should have had left, head, right shoulder stays under 486, consolidation, break the neckline. That would have been a bearish reversal. As of Friday's close, that's certainly not the case. And as I'm talking about patterns, bear with me as I just quickly go back to the S&P 500, but it's the same concept over here. You could have had left, head, right shoulder if we stayed below 572. That's not the case, and obviously we're looking for that all-time high breakout. The other thing to point out here, which is really along the lines of why we're waiting patiently for the bearish outcomes underneath 566, is because if you're going to view this through the lens of a double top, you have to break down underneath the neckline, which is 566, 565.25. It's that weekly inflection point, right? So just as we're thinking about patterns, that's the explanation there as well. Back to the NASDAQ, though. We've sort of covered the daily. We know that things start to deteriorate underneath 477. Consolidation over 486 probably looks for the equal pivot high here at 493.10. Beyond that, you're really looking at 499.50. That's that level that's very close to 500, the psychological number. And the all-time high is at 503.25. That's what you've got to the upside. We are sitting in an uptrend, and there was a nice gap fill reversal on the Friday session. Here it is on the hourly time frame chart. Once again, I just want to sort of reiterate, be my guest if you want to trade aggressively inside of this range, but got chopped up, chopped up, right? Pretty ugly action in there. The gap fill reversal is a little bit cleaner out of the NASDAQ on Friday, which is a bullish indication. As long as we get consolidation and acceptance over 486, looking for the equal highs up here. If we fall back down into range, I'm not sure that I would just short it in that instance. I would probably be looking for a lower high to at least accept inside of this consolidation underneath the intraday pivot high from Thursday, the low of day from Friday. That's 483 as a minor level. And really, for the bears to have the most fruitful outcome to the downside, as we've already described, and this makes sense on the hourly, you've got to get down underneath 477, then all of this turns into overhead supply. After Friday's close, it would seem as though that's a lower probability outcome early on in the week. With this gap fill reversal, basically the hourly chart has said we have lows, higher lows, highs, higher highs. We're looking for higher low consolidation. I know I sound like a broken record, but that's it. You're looking for that hold over 486. That's your key level out of the QQQ early on in the week. Let's quickly check in on the intraday anchored VWAPs. We are above the entire cluster. Why is this jammed all the way to the right? Let's see if we can fix it. There we go. You're above the cluster of anchored VWAPs. Once again, a little bit more bullish than it is bearish. Probably would not flip bearish if we're over that 483 because that is the anchored VWAP cluster. If we're underneath, okay, starting to become concerning. Daily, lower high, and then the neckline break, of course, is where the floodgates open up for the larger move to the downside. So leaning a bit more bullish than bearish, but it's got to prove itself early on in the week. Let's quickly check in on the NASDAQ side of the internals. You'll see strong volume inflows on that Friday session, in trend higher zone early in the day on the advanced decline line, and a cumulative build that's actually positive for the NASDAQ. So once again, it makes sense that we probably want to have a slightly more bullish leaning here in the NQ versus what we were talking about over in the S&P 500, where the buyers really need to step up and prove it still. If we take a look at the NQ market profile, what do we see out of the value area here? You're still getting some overlap with the value area inside of that Thursday range. The point of control is inside of Thursday's range as well. So I'd say this has similar bearish-esque style, just not as perfect as it could have been. Style indications just like the S&P 500. Not much difference though. One thing we can read into a little bit is just the fact that this, of course, as a level, was the single prints from what would have been the Tuesday session in that morning breakdown. You got some retracement through it, but you didn't really make it all the way to that equal high, even with a gap up on that Friday session and a pretty positive catalyst from the labor report. So again, starting to find some slight cracks in the armor. It's not enough to just say short the NASDAQ, but my goodness, these minor nuances are worth picking up on just a little bit. Let's move back on over to the platform and we'll finish up the broad market with, of course, the small caps. Let's go here. Let's go here. Let's go to a weekly chart for our IWM. Clean drawing set, and what can we see? So let's keep it simple. Let's do the things we always do, candle structure and location. You've got a red-bodied hammer, and it's more of a doji than a hammer. The body is almost non-existent. However, it did close back inside of the previous week's range after breaching the previous week's low. It doesn't look great because you didn't see range expansion really stick in the upward direction for that green-bodied close like what we saw on the NASDAQ and the S&P. However, it's not as bad as it could have possibly been. That sort of seems like the theme of this market right now. The other thing is that you're still staying outside of this previous balance range from back here. If I make that a little bit more accurate, it's very possible that you're still just chugging along in the upward direction, looking for a weekly higher low above roughly 210, just to use round numbers, right? So the weekly chart's really not all that bad. If we come in here with the anchored VWAPs, you did use this as support. Beautiful. As long as that continues to hold, that's looking pretty good. Let's come in with the Fibonacci's from the swing low here, back up to the high. Dipped into the 50% retracement, but closed over the 38.2. So probably leaning once again a little bit more bullish than it is bearish here on the weekly time frame. I'd also like to take a quick look at the volume profile here on the weekly, just to make reference, right? This is the huge node below. This is the intermediate 1.5 block. We're trying to build a second block to the upside. Where are we relative to this high volume zone? We kind of closed right at it. Ideally, we start resolving this in the upward direction to be more bullish out of small caps and to avoid a little bit more so of that recessionary theme that we've been talking about for the past couple of weeks. Let's drop this down to a daily chart for the small caps and see what's going on from this perspective. So weekly expected move, here it is in this box right here. Upper bound is 224.68, lower bound is 213.60. Equal high from a swing perspective and equal, maybe slightly lower low from a swing perspective as well. Not really all that constructive on the expected move. It seems kind of neutral to me, more so than anything else. The 215 is the daily higher low line in the sand because of what we see happening here, because of what we see happening here as the neckline to the double top. You've got to stay over that level. And so far, so good, with support coming in after that Thursday session, gapping up on the labor report from the Friday session. I like the more pure play gap fill reversal out of small caps here, as well as we had some concerns about this acting as a double top. This would be your neckline. We've closed above that on the Friday session. Over 218.50 is a decent little indication. Now, I'm not going to say that this chart is, cleanly trending in any particular direction. It's more so balanced. We know that. We've been talking about this for weeks and weeks on end. It would be best in the immediate time frame if this turned into a left, this turned into a head, this turned into consolidation for a right shoulder, and there was some attempted break that looks like this over 221.75 to kick off small caps in the upward direction to at least make a weekly equal high. And then really over 225.25, that's where things really open up for small caps. This would be a massive bullish indication and probably a huge tailwind for the S&P 500 as well. If you're just getting continued sideways consolidation, maybe you come back down and you test 215, I would start to become concerned with highs, lower highs, potential lower highs if it's just sideways and then lower. Any attempts at 215, now that we've already tested it once, the door is open. What goes straight up, or let's start way off to the left. What goes straight up comes straight down. Goes straight up, comes straight down. Goes straight up. This could easily come straight down to the weekly line in the sand, which is at 207.80. That, of course, would be bearish pressure for the S&P. We're not there yet. The leanings are slightly more bullish than bearish, but I did just want to walk through all of those outcomes, noting that generally speaking, the trend here is much more sideways, right? So let's take a look now at the hourly side, see what else we can learn. So here it is, left, head, potential right. Need to stay over 218.50 if we can get that consolidation moving to the top end. And then because this is such a well-respected level, I would probably look for the first test to back off of it. Then if we can get another hourly high or low, second test goes through, right? It's such a mechanical and visual level that over 221.75, I think you get a snappy move here out of small caps. If you trade small caps, you know this, but typically you get a really early morning drive and then nothing into the afternoon. Early morning drive, nothing into the afternoon. Like small caps has that personality. So I'd love to see like an hourly pullback here, sets up the open underneath. Early morning drive above gets us for this breakout, and that would help the case for an S&P 500 all-time high breakout. We'll see. It's not a little bit. It's certainly speculative as of right now, but it's something that I would lean into as a possible pathing outcome if we see it unfold. If we're getting this consolidation down here and the S&P is inside of its daily balance range, I mean, you're probably looking at a very difficult market to continue to trade on the intraday time frame. We'll quickly check in on the intraday anchored VWAPs out of small caps, making some progress. Remember that we were underneath a majority of the cluster here when we checked in on Wednesday. Some progress back to the upside, but once again, it becomes clear that over 221.75, you're above the cluster and probably looking at the ability for a cleaner break to the upside. Let's quickly check in on the Rusty Russell internals. What do we see over here? Substantial volume inflows, not quite on the Friday session. So I like the gap fill reversal, but again, not really getting the love here at the exchange level. This is okay, but it did end up spending more time underneath trend higher zone. It's still certainly positive. Don't get me wrong there. And then the cumulative build also positive, but sort of flat into the afternoon, meaning that for the most part, you saw a little bit of an uptick here midday. this move, right, as this is taking place. But into the afternoon, you didn't really see sustained buying pressure across the Russell as an entire index. So, really, I think that the main takeaway is that we're probably neutral in some of these boxes. You've got to see the clearance of sort of this as a range. We know where we're leaning bullish, absolutely here for this, and we know where we're leaning bearish, absolutely here for this. But you've got to see it happen. You need 215 and you need 221.75. One of those two outcomes here will drive some clarity out of smalls. Let's quickly check in on the Rusty Russell market profile just to see if there are any nuances we should be picking up on over here. The best thing that we can say about this, which we couldn't say about the other market profiles, is that value is completely breakaway to the upside. Point of control is nowhere close to the Thursday high, and it actually closed even higher than what we had on the Wednesday high. So progress in the upward direction, absolutely. We are looking for the continued retracement of A period single prints from back here, which would really get us over that 218 level we were just talking about on the IWM. Let's reset this and let's start talking about our S&P sectors. What do we see in terms of the weekly performance? This is not filtered, it looks like, by weekly performance, so let's try that. There we go. The top of the list is energy. On geopolitical tensions, we know that. We're going to continue to monitor that crude chart, really. It's the CL. Is it the supply restrictions or is it the demand, really, that's just waning? We've got to figure that out over the next couple of weeks. Semiconductors are second up here. You can see up 1.5% on the week. Financial sector 1.35%, then communications. Looks much more like a healthy risk on end of the week versus risk off. At the bottom end of the barrel, not that this is an S&P sector, but it is the TLT technically, down 3.13%, followed by consumer staples. Consumer staples are absolutely D for defensive as a sector. Again, it's looking more like a risk on rotation is trying to take hold of this market. Materials are a very lightweight sector. They don't move the needle all that much. And then it's real estate, which could also be seen as defensive as a hard asset, right? If you think about where the heaviest weight sector is, the XLK, it's technically green on the week, up 52 basis points. Let's check in on the structural charts and see exactly what's going on here from that perspective. Why is this not linked? This is not linked for some reason. Let's try that again. Here we go. All right, XLE. Geopolitical tensions, straight to the upside. So there's not much to really say other than you've got to respect what the chart has done so far. If this is all accumulation and you've got left, head, right shoulder, as long as you're sort of over this 90-25, I could imagine that maybe there's progress in the upward direction. And if that's the case, then the supply side restrictions probably are what had caused price to move higher here, or at least what I'm trying to say is if we think about what crude's doing, right? Let's go to the CL just as a proxy here for the actual oil prices, right? If we're thinking about this chart, this was a pretty major level for us, right? We had set a potential lower high underneath. Notice that this to this is a higher low. So prior to this even breaking out up and over the level, let's sort of disregard that. If global demand was stepping back up and if we're going to avoid that whole recessionary theme, then this higher low is the first signal. And then from a pure play technical perspective, as soon as we breach this for a higher high, the thought process should now be, if this pulls back and finds another higher low over $72 a barrel, excuse me, then that absolutely avoids the recessionary theme. So that's how I'm thinking about this chart. That's how I'm thinking about energy as we move forward. Is it going to be instrumental for the S&P 500? Likely not. So let's get into semiconductors, which are absolutely more instrumental, or shall I say consequential for the S&P. You're holding this 50 SMA for a potential higher low. You're holding the 237. That's absolutely critical. On the daily, you are getting gap fill reversal over the Thursday range. So really your next steps here are, can we get back to the equal high? And if so, will this ascending triangle break out, right? If this is your ascending triangle, does it break out over 255.70? That's a top watch if this market's going to make a run for all-time highs and sustain all-time highs in the S&P. So consolidation here is bullish. This absolutely sets up blue sky breakouts in the S&P. If we're under 237, I wouldn't really short semiconductors under 237, but I absolutely would underneath 230.75. If that takes place, obviously downward pressure in the S&P. As of right now, leaning a little bit more bullish. You could also, of course, look at this through the classic lens of double bottom neckline. You know, you could call it like another segment of the double bottom, 1, 2, 3. At that point, your ascending triangle. You get the point. The chart is constructive. I like the structure that's building out. Let's take a look at financials. Another beautiful looking chart here with a third equal high attempt at the all-time high. If this gets consolidation or if this goes through, that absolutely will act as bullish pressure for the S&P, noting that financials are the second heaviest weighted sector by market cap. So watching this very closely. What else do we know is relevant to financials this week? Well, Friday is going to kick off earnings seasons with none other than JP Morgan and some of the big banks starting to report. So keep an eye on that. Do we get a breakout of this flat top that is bullish for the S&P that's over 45.75? Next up, communications look great, trading near the equal high at the all-time high, looking for follow-through to the upside. This is not bearish by any stretch of the imagination. Utilities trading near all-time highs, not bearish, looks fine. It is D for defensive. We'll be concerned if the semiconductors don't break out, if financials don't break out, then we'll be a little bit more concerned about what's going on here. But for now, let's take a look at the XLK. Technology trading near that equal high, probably closer to the equal high than the SMH after a higher low being set here. So lows, higher lows, soft higher lows for sure. If we can trade into this gap, once again, bullish pressure for the S&P, that's over. You're looking at 228.15. Gap closes at 231.80. Chart looks good. I'm not seeing any red flags out of these sectors so far. XLI Industrials looks like a bull flag near all-time highs. How could it not be bullish? Looking for upward pressure there. Let's move along to the TLT, absolutely collapsing, dropping like a rock on the Friday session, on, of course, the labor report. And we'll talk more fundamentals in just a moment, but just pointing that out. Let's take a look at XLP, D for defensive, dropping like a rock underneath the neckline of the head and shoulders that we've been talking about. Because it's defensive, I'm not really concerned with this by any stretch of the imagination. Materials, coming back in for a pullback. It's the most severe pullback we've seen so far in the sectors, but it's well outside of this consolidation range. If it does something that looks like this, bullish pressure. This is the lightest weight sector for the S&P. It's not going to make or break anything. Real estate, mild pullback. We know what's happening with rates. We know how the labor report impacted things. We know that it's probably going to be higher for longer, which is fine. I think that's what we want to see for a soft landing. So pullback in an overwhelming uptrend. I really don't think you want to be aggressively bearish on a chart that looks something like that. Discretionary, pullback in an uptrend after a breakout, finding a higher low on Thursday over a key structure, it looks bullish. If this turns into a lower high, I would be concerned, but I would only action bearish if we fail underneath the neckline, which would just be this retest level again at 193.50. Then finally, the XLV healthcare, as we know, D for defensive. However, not second, but rather third heaviest weight sector for the S&P 500. And this is breaking down. As long as it holds this, I think we're okay. Consolidation here is bullish for the S&P, obviously upward pressure if this. I start to become a little bit more concerned if 150 can't hold, because that's ideally where the weekly higher low would be found over this previous breakout point. So watching this very closely early on in the week, I will point out that on the Friday session, we swept the Thursday low, but closed over the 150. So slightly more bullish than bearish in the immediate term, noting the failure of the sellers to continue, looking to see if we can get that hook back to the upside, forming some kind of weekly higher low here. Let's jump on into the ratio grid and see what's going on from this perspective. If you're not familiar with this ratio grid, by the way, check out the video tutorial in the top right-hand corner. XLK is still sort of moseying along sideways, not really doing anything impressive. So therefore, I find it very difficult to say that we have a full-blown risk-on style look. Ideally, this makes a new swing high. If the market's going to go for a new all-time high, this has to get some sort of break over this swing high. If that happens, great, slightly more risk on. If financials break out through the 3 equal highs, ideally this gets back up and over the 50 SMA, and discretionary here wants to find some kind of higher low. There's plenty of opportunity for that. So these two right here definitely strike me as looking slightly more risk on. This one's still a little bit neutral, and once again, noting what we said in the intro, the buyers still have a little bit of work to do. XLP coming on down, looks good. That is not a threat for risk off. However, utilities are still hanging out near those highs. That's slightly more defensive in terms of posture. Let's check in on some of the specialized ratios and see what's going on from this perspective. So up first is going to be SHY government-backed bonds versus the XLK. Again, if the S&P is going to make a break for new all-time highs, you need to see a break of this flat top. I do like the fact that we are continuously forming higher lows. It's just a matter of getting a new swing high now. If we take a look at utilities relative to the tech sector, notice that this does not look as good. So one chart looks great, one chart does not look so good. Let's come in here with a resistance trend line. I mean, a very classic bear pennant, descending triangle. If you make a new swing low, once again, looks difficult, or it becomes difficult to say that we have a full-blown risk-on look in the market. This looks great, so we'll take the tally when we're complete, but I like the higher low. I like the break to the higher high on Friday's session. This is bullish. This is risk-on. Let's take a look at by the way, this is discretionary versus staples. This is semiconductors versus healthcare. I like the low, head, right shoulder over the 50 SMA. I like the fact that if you just do something that looks like this, we have a flat top potential break. So if this wants to go fine. A little bit of a step in the right direction. Maybe I think what might be most appropriate, let me walk it back a little bit here. I don't want to be overly optimistic and skew some of the data here. Because these are flat highs, we do not have big pivot highs. I would say bullish, but kind of a little bit more neutral. Bullish, but a little bit more neutral. This absolutely does not help the bull case. This absolutely is bullish. So maybe these things cancel out and we get a little bit of a bullish edge, but nothing overwhelming, nothing over the top. I think this really reflects the sentiment we just saw inside of the actual structural breakdowns as well as the individual ratios as well. If we continue to talk about the foreign markets, we're all set. I mean, the yen carry trade is basically a nothing burger at this point. We're going to start eliminating this chart, possibly in preference for something like EEM, which is just emerging markets continuing to hang out and consolidate near the highs after the break here. So with the China stimulus, emerging markets look good. If we had really global concerns about a recession, that would not be the case here on the EEM. Let's quickly check in on the Qs versus small caps, just because this ratio sort of tells us when we want to dial back expectations about continuation in the S&P 500. So long as this is sideways and attempts to make a continuation move higher, that would be bullish for the S&P 500. Let's quickly check in on our dollar. One thing I want to point out here is that this is starting to form a little bit of a double bottom. Just make note that as the dollar moves higher, right, that technically tightens financial conditions. Maybe we should start thinking about the potential for downward pressure out of the S&P. We're not there yet. It's something to think about as a potential relationship. If we get this higher low and like a screaming rally to the upside, if it looks like there's going to be no Fed rate cut in the month of November, and we'll get to this stuff, that to me, the tightening of financial conditions after the expectations that, oh my goodness, the Fed's going to drop rates to zero, metaphor, hyperbole, but you get my point. This is something to just continue monitoring. So this rapid ascent out of the dollar just hasn't quite caught up with what's going on in equities yet. So we'll keep a very close eye on that relationship. Speaking of things of this nature, let's take a look at gold. We've been talking about this for a little while now, but the fact that gold broke out was more of a technical breakout. If you actually use a ratio of gold to the S&P 500, notice the downtick over the span of last week. And really what that would suggest to me is there's no flight to safety unfolding here. As we take a look at interest rates, let's go to the 10-year first. Big uptick here on the labor report with the assumption that the Fed will not drop rates as aggressively as some people were forecasting to begin with. This was like maximum, oh my God, the Fed is way behind the curve. We know that the Fed's not. And this, like, I don't want to be like the, hey, I told you so guy, but this was sort of my analysis all along. Nobody should be shocked about what happened on Friday. We'll talk about why. But anyways, just understand that rates moving higher, dollar moving higher, financial conditions slightly tightening here after they loosened very aggressively and the market didn't really make a huge break to new all-time highs. Slightly falls into the cautious category for sure as we take a look at the 2-year, which is the inverted ZT futures, right? Big move to the upside again on that labor report. So no surprises here. Let's jump on into the Fed tracker tool and see exactly what's going on, because what you'll see is we went from pricing in odds of a 50 basis point cut to no odds of a 50 basis point cut, almost guaranteeing a 25 basis point cut, or even suggesting that there's the possibility for no rate cut in the next meeting for the month of November, right? If I go to the compare tab, you can see this stuff. You know, this is basically saying like, we're unsure. This was like 50-50. Maybe we're going to get the 25, maybe we're going to get the 50 basis point cut. This is almost the guarantee of the 25 basis point cut, right? And I think a lot of this hinges upon what we mentioned in the intro. The CPI inflation report comes out this Thursday. That's the next major tell for what the Fed should really be thinking about here. We could take a look at the calendar, and I want to walk through some of these things. The JOLTS job openings, let's talk about jobs, right? Because this was the week for jobs. They looked great. 8 million versus the 7.64 expectation. Awesome. ADP non-farm gave us a directional vector that, hey, things are looking good. There was a nice beat there. It wasn't necessarily about the magnitude. It was just like, okay, beat. That's helpful. That's healthy. You're also getting a revision of the previous from 99,000 to 103,000. That's against what everybody had sort of forecasted. Everybody's like, oh, revisions are always to the downside. These were revised up. And as we take a look at the weekly initial jobless claims and continuing claims, no red flags there. ISM services come in hotter than the expectation. We'll save the inflation talk for the forward-looking stuff. But let's talk about Friday, where we had the full labor report released. Is anybody shocked that the unemployment rate actually ticked down? You absolutely should not be shocked, right? How many times did we say that the weekly initial claims showed no further deterioration in the unemployment rate? I mean, again, not to be the told you so guy, but that should not have been a shocker. The non-farm payroll absolutely smashed the expectation here. Again, even if these numbers get revised to the downside, 254,000 versus 147,000, say they shave off 50,000 jobs there. you're still well above what the forecast number was, and the previous was also revised in the upward direction. The hourly earnings I'm not overly concerned with. There's some talk about wage price spiral putting upward pressure on inflation here. Really not concerned with hourly earnings. I think it's more about housing inflation. We'll talk about why in just a moment, but let's take a look through some of these charts here. Here is the breakdown of the unemployment rate and how things came out. Here you can see the downtick, and I actually want to bring up this chart over on Thinkorswim because we can track the SOM rule in real time over here. Let's see if they've updated. Did we get? Yes. Okay, so we have the updated 4.1 being reflected on the Thinkorswim data. So a downtick in unemployment. And notice the SOM rule. And this is a pretty decent statistical predictor of recessions. It's back at the 50, which is the trigger point here out of the SOM rule. So another, I should say, another strong unemployment number, meaning a weak read, something that's like 4% or less in the next monthly report, probably sends this back down, untriggering the SOM rule for a potential recession. That's something to keep a very close eye on. What you'll notice here is every time a recession has been triggered by this rule, it's a much steeper, I wouldn't call this inversion, but break of that 50 mark for the trigger, right? Look at how deep these are compared to what we're dealing with over here. You can hardly even see it on the chart currently, right? So I don't think that there's going to be a labor market recession based on all the information that we've sort of discussed so far. And once again, not to be the told you so guy, but we've been tracking this for weeks and weeks on end. This is why I think it's worth tracking. You know, we're not much of a fundamentalist channel, but you know, if you can at least understand that these numbers shouldn't be a big surprise, I think that's helpful. So anyways, this is the tweet. We've been tracking it. We'll continue to track it, so on and so forth. Let's take a look at the actual breakdown of where the jobs are being added. And the big concern, of course, and I'm sure it's going to be in the comments section here, is, hey, the government added a majority of the jobs here. Well, I would say they really didn't. Yes, there's 31 on the month-over-month net change here that were added, so there's a decent chunk. But look at leisure and hospitality. Look at education and health services. What I really want to focus on, I mean, this makes sense, right? Because of the way that you go back to school. Great, this is the September read, no problem. But leisure and hospitality would imply, right, those places are not just going to hire help because they feel like giving out free jobs. That means that there's demand for leisure and hospitality. So as we think about the recessionary theme, this is not at all in alignment with what would happen in a recession. These jobs would be getting cut down immediately, right? Construction, also a decent contribution here, 25 on the net, obviously 1,000 contribution. That directly speaks to the cyclical side of the economy. Right? As you look at professional and business services, a little bit less. If you look at information, a little bit less over here. Trade, transportation, utilities, a little bit less over here. But generally speaking, this report looks really strong in terms of the types of participants who are getting involved in this labor market and sort of keeping things moving in the right direction. Let's take a look at this. Now we can start talking about inflation. This was the ISM Services PMI. We're going to start forward looking, right? Labor, it's a done deal. No deterioration. Weekly claims look good. The month-over-month numbers look great. No problem. Let's talk about inflation. This is last week's ISM Services PMI report. What we want to focus on is whether or not there's a divergence between the blue and the yellow line. There's not. Notice how they're actually right on par with one another. The yellow line is business prices. The blue line is new orders. New orders have skyrocketed, meaning that there's plenty of demand, and prices didn't, I mean, they moved in the upward direction, but they did not skyrocket. So what does this say about potential services inflation? This is actually bullish, saying, okay, maybe services inflation is not going to be all that bad. If you take a look at the previous CPI report, this is where I would say it's not really about that style services, it's about shelter. We know that the CPI shelter read actually saw an uptick in the previous August reading here from a 0.4 to a 0.5. That to me is going to be your top watch. Please, on Thursday, and you'll hear me talk about this in the pre-market prep. We'll have coffee and donuts. We'll go through the report when it comes out live. You're going to hear me reinforce this stuff on Wednesday as well. But shelter inflation is going to be the nail in the coffin for the potential of stagflation, right? We're already sitting at a 3% GDP. If that slows down and shelter inflation moves higher here as we start to price in what's going on from the Fed cutting rates, the 50 basis points in September, that I think sets the stage for potential round 2 of inflation. If I think about, this is anecdotal, so take this with a grain of salt. If I think about my local real estate market, where I'm an active investor in that market, deals are going in less than 7 days. And these deals do not pencil for a positive cash-on-cash return, right? Standard financing. So what does that mean? It means there's plenty of money still on the sidelines waiting to do creatively financed deals. I mean, they're taking losses on this, or again, with creative financing, maybe making something work. But the idea here is appreciation over time. If the housing prices aren't going to come down, I don't see how the shelter costs are going to come down here, and the Fed's really going to make a move towards 2% sustained CPI inflation. So that's my general take, and that's why we talked about stagflation, or at least mentioned it in the intro. That's what we want to be very cautious of as we come into the coming week's worth of trade. Let me quickly go back to the calendar here so we can see the lineup of the coming week. It's Fed speak galore, so be mindful of that as well. Early on in the week, Fed speak, Fed speak, Fed speak, Fed speak. So much Fed speak. We scroll down. FOMC meeting minutes should not really be a shocker. Pay attention to the 10-year bond auction. That's Wednesday at 1 o'clock, but it's really all about this. On Thursday, October 10th, the CPI report. What's going on with services inflation? We'll be live. We'll be up in the penthouse. We'll do the pre-market prep. We'll have coffee and donuts. Come hang out. Thursday morning, we'll start the stream at 8 o'clock, as we typically do. A couple of things. As we got the report about labor and sort of the fears of recession based on jobs sort of went away, I want to point out what happened with the long end of the curve versus the short end of the curve. This is basically the market responding to saying, hey, we actually do think that there's some risk of inflation surging back. So let me just draw a line here. Everything below is the 2-year, 3, 5, 7, so on and so forth. That's what you want to focus on. Notice that just on a relative basis, the 2-year yield was up 21 basis points, whereas the 30-year, the longest end of the curve, was only up 7.3 basis points, right? So what this is telling you, if you're looking at durations here, generally the market's a little bit more fearful of possibly inflation coming back, which is why we're not pricing in anymore the 50 basis point cut on the Fed Watch tool, right? Just sort of bringing it full circle with how this actually is being communicated here as well. And, for people who like additional information, let's come in here and let's open up the 10-2 curve, right? This is another classic way to track this, but you're also seeing this move in the downward direction, right? Getting closer to an inversion again, once again, fearful of some kind of inflation, shorter end of the curve moves in the upward direction. You need to be paid more to take those risks on, right? So that is what's going on with the bond market. I do quickly want to look at the earnings calendar here as this loads up and point out, as we mentioned on the XLF, you have JP Morgan, Wells Fargo, BlackRock, Bank New York Mellon, I believe, BNY. I thought that they actually, unless they updated their logo, that might be a new logo for Bank New York. But anyways, they're going to kick off the end of the week. Prior to that, nothing interesting. Maybe Pepsi before the open on Tuesday, but other than that, oh, Domino's. There you go, right? Everybody loves a Domino's pizza. Not. So JP Morgan, banks, Friday, earnings season is upon us. Let's get back on over to the charts here. Let's finish the job. Let's take a look through the risk appetite indications. TLT ratio to the S&P is breaking down. No flight to safety over here. I told you I'd bring it up when it would break down, and there it is. Let's come on over to our bonds relative to themselves. This is exactly what we saw with that screenshot of the different durations. You can see a preference for the shorter end, shorter end, shorter end. This speaks to, again, maybe some fear in the bond market about a resurgence of inflation. Thursday holds the key with the CPI report. If we look at credit spreads, they continue to drift in the downward direction. Breakdown on Friday, breakdown on Friday. That, of course, is bullish for equities down below. What about the high yield junk bonds in isolation? Whoa! Red flag. Here we go. Bearish divergence, right? From here to here, the close on Friday, you got no love. You could say the same thing out of the LQD. This has been this way for a little while. Look, notice the breakdown's much more aggressive out of the LQD here, right? So making a brand new lower low, not just a lower high. That's something to pay attention to. And once again, proves the point in the intro that you probably still need to see some continued improvement from the buyers if this is going to be a clean break to the upside. Let's take a look at the BTC, digital gold. What's going on here? A little bit of a move back into the range, but pretty stable. I'd say as a risk asset, it's just kind of doing its thing. It's kind of in line with the market, waiting for this inflation data as well. Small downtick out of the moving average charts as well as breadth here, but still over the zero line on new highs versus lows, well above the 50% mark on the moving averages, so no big cause for concern yet. This will be echoed in the RSP as well, trading near those all-time highs, pretty much on par with the S&P weighted. QQQE, same concept, almost lockstep with the non-weight or weighted and non-weighted. You get the point, no major divergences there. Industrials versus transports. Transports have continued to lag for a very, very long time. Nothing new to really talk about there. Let's talk about volatility, because I think that vol is going to remain elevated as we approach the CPI release. If CPI is hotter than the expectation, I would start thinking about a volatility breakout and therefore a move to the downside underneath that big sort of level we had been talking about in the SPY, which is 566, 565.25. Everybody should, at this point, have that seared into their mind. I mean, we've said it how many times now for like a number of weeks. So if volatility breaks out, expecting some downside, generally speaking, it is still elevated over that 15, using it as support here. Let's get into the VVIX. Volatility of volatility remains elevated. What we were looking for earlier on in the week was this. Even on the labor report, which I find very, very interesting, there was no collapse of volatility after the labor report. So what does that mean? Once again, based on the bond market analysis that we just conducted, it would seem as though market participants are maybe fearful of a wave 2 inflation, which causes stagflation ultimately. Volatility futures are still in a backwardation. I think that this is due to the November contract pricing in the risk of the election. So we'll take a look at 9 versus 30-day VIX. That's certainly up in a normal contango. And the 1-day VIX, once again, on the release of the labor report, I would have expected a further move to the downside. I think this reinforces that stagflation fear. That's really what volatility is starting to suggest to me. And even the skew printed a new high. I mean, look at this thing up here. This just basically prices in black swan or tail risk event, right? Or I should say tail risk. Yeah, not tail risk event, but you get the idea. Tail risk, 30-day plus options in the S&P on the put side. Certainly trading near these highs, which just continues to reflect that people are not really confident about the market here near these highs. I think that the weekly structure looked great, right? We did that analysis, but generally speaking, I don't think we're firing on all cylinders, which is once again why in the intro I had acknowledged that the buyers do still have some work to do. Let's take a tour through the core list of companies, and then we'll give you 3 trade ideas and you'll be on your way. What do we see here? Apple inside the balance. Ideally, it gets out of the balance with some sort of Brigade bolt, high or low, for a move over 229.50 and then all-time highs. Here it is on the hourly chart. Remember, these dailies just look like hammers, right? So be my guest. Once again, just like the broad market, you want to get chopped up in here? Be my guest. I think that this is a little bit cleaner just because of the way that we have less structure there. There are more positions that'll be needed to be defended through this zone. Bears probably don't have anything going on unless there's a clear lower high underneath, in which case all of this turns to overhead supply. You could maybe think of this as a double top. Next up, Microsoft. A little bit more detrimental on Microsoft. Let's go daily chart first, just to reinforce that we're underneath this pivot high. We've been talking about this in the pre-market prep. Looks like bear flag consolidation here. Even if it rallies, I think a lower high attempt is definitely possible underneath that 425.25. So thinking about that, on the hourly, you can start to see maybe, just maybe, the beginnings of an inverted head and shoulders, meaning that if you get this, I mean, you could trade it counter trend from, let's say, A to B, but at point B, this is exactly where I would look for the daily lower high. Not a DHL shipment, but a daily lower high, DLH, all right? So something that then looks like this, back to the downside for trend continuation on the failure to hold that daily pivot from back over here. Let's jump on into NVIDIA, starting to resolve to the upside, this pretty annoying level, for a lack of a better term. But I like the way that it's getting in gear. I like the fact that it's closed back inside of this overhead balance. Now it's just a matter of determining whether or not we can get continuation. So on Friday, we technically opened on a gap up. We drove deep into the Thursday range, closed back above. This is thin structure you're holding over, as of Friday's close at least. The mosquito pattern, shoulders, head and shoulders, I get it. Over 124 is bullish, right? Looking for continued consolidation here, drives to the top of the daily range we were just looking at, 129.50. If it pulls back, I would say that this is maybe a second chance opportunity for a long here at 120.50 that then looks like this again into the future. So you might try this risk reward here as the first idea and then balloon runners that do this, or you could just wait patiently for this higher low over 124 to capture this range. The bears only have something going on out of NVIDIA. If this big time lower high sets into motion, huge overhead supply on the daily. Right, that's your breakdown here. We're not even close as of Friday's close. Next up, Google, the continuation trade, the catch-up trade continues. Building out a new block, right? This is clearly just going building block 1, building block 2. The next step has to be something that looks like that. 169 targets 173.25. If you break the building block low, you probably navigate here. I wouldn't short that. I would short the breakdown underneath 161.50 to retarget the bottom end of this, which had set the range in the first place. Next up, Amazon Nancy. What's going on over here? A much cleaner higher low. This is a much better looking chart than Microsoft. So this looks awesome. This is about as textbook as it gets as an inverted head and shoulders. Here it is on the hourly chart. It's almost an island reversal as well. There's technically a little bit of a gap in there from Friday's low. So island reversal, inverted head and shoulders, looks great over this neckline, over 186.25. Good to go into this level here, 189.25. From there, the stronger continuation play is consolidation and then continuation into 195.75. I would be much more skeptical of this chart when we're under 181.50. So keep in mind, If we break down and look like this, I would not be a short here. I would actually start to think about, okay, what are the odds that this maybe turns into a longer standing double bottom and we can entertain this into the future? I would be bearish when and if there's consolidation below 180, 150. Next up, Metaverse. Mark Zuckerberg has done it again, the richest man, second richest man, with the breakout on Friday, surpassing Bezos, of course. Just the strongest name in the market right now. There's nothing bearish to say. You're just looking to find entries so you can participate to the upside. That probably requires some kind of higher low. You could use what some people refer to as a chasing tool, which is just the Fibonacci. You could come from here to here. You've got 590.70 just based on Friday's range, or you could come from the low of the breakout to the high of the breakout, which is basically the top end of the intraday opening range out of Friday. That 38.2 is at 586 for round number 6. So pullback longs that look like this potentially, or that 590 level we were just talking about as well. That's it. Really bullish until, bullish out of Meta. Let's take a look at Tesla. What's going on over here? Again, starting to look a little bit on the hourly at least, like inverted head and shoulders neckline is very clear at 250. As we've been talking about in the pre-market preps, expect this to be more of a grind just because of the way that this is not thin structure. That's overhead supply that you'll have to work through. So definitely still entertaining this long, but just manage expectations on the speed of the actual move. If we're underneath 244, I wouldn't really flip to the short side aggressively. I would still be thinking about longs off of 234.15 because of the daily pattern, of course, which is this inverted head and shoulders, right? You could also talk about it through the lens of ascending triangle, something that broke out. You could retest the top of that, sort of flat top, if you will, at 234.15 and still get a move in the upward direction for continuation. Next up, JP Morgan earnings on Friday. Flat top is potentially under scrutiny here after a massive gap fill reversal on Friday, having initially set a downtrend. Like this chart is not a friendly one to trade intraday. However, if this break can hold on the hourly, I want to be very clear there, you need like concrete examples of this holding higher low acceptance over 211.50, 215.75 is the potential target because of the thin structure off to our left. Instead of looking for a lower high, now that this is technically trying to set a higher low, you're looking for this to ultimately turn into a double bottom over the neckline. There you go, 215.75. So either this continues to keep it on our radar. This is where we want to action for this idea. And keep in mind, earnings on Friday will mean that the premiums will be inflated the closer we get. Next up, Netflix. What's going on with Netflix? Definitely breaking out of this on the Friday session towards the high. This is all-time highs out of Netflix, so over 724.50. Blue sky breakout. The only time to even consider shorts is under 703.50. Does not look likely based on Friday's close. If we take a look at the hourly now, you can see that, right? You got this sort of gap up, sporadic action in the morning, but the fact that we close back stronger here does look stronger on the bull side, of course, rather than like skeptical still of this hold over 712. If the sellers were going to make it happen, they had the opportunity to do so on the second hourly bar. You got this push higher, which failed, admittedly, and then this sort of comes back down again. Sellers had their chance right here. Does not look like they took it, and strong close on the hourly. AMD, awesome move as well over the past Thursday and Friday session. Huge hold of this key inflection point, 159.25. Great higher low in the trend count. Lows, higher lows, higher lows. Soft higher lows, definitely a higher low, straight to the equal high, looking for this gap close overhead. 169.75 closes, 174.50. Beyond that, 180 becomes the target. This is all thin structure off to our left. Really, high interest here, for me at least, out of AMD, looking for that continuation. If it does pull back this time around, the higher low needs to be over 162.65. Here's why. Take a look on the hourly. If this is an hourly double bottom for the reversal, you've got to hold up for some kind of higher low over that neckline. 162.65 is that number. Let's move into these three trade ideas, and then you are on your way for the evening. CMG, not GME. Oh my goodness. CMG. There we go. Oh, GameStop, get that out of here. The world's not most expensive burrito anymore after the 50-to-1 stock split, but I just like the way that this mild consolidation is taking place. You have multiple inside bars into the end of the week. You did get this close over 56.75, so continued consolidation, then a potential break up and over 58.85. This is a slower trade setup to watch. It's probably not something that's as day tradable as what we're talking about in the core list of companies, but I did like the structure here on this potential hold of the ascending triangle breakout. Nice mild consolidation. Hammer candle, inside bars, just makes sense here to be on watch for a potential long like this over time. Maybe it turns into a very small swing trade with just like common shares or something like that. So that's Chipotle. Next up, sticking with the food category, actually, we'll switch these. Let's go Starbucks, SBUX. Goodness, with the spelling today. So this daily chart, very similar. in the sense that you have these grinding higher lows, you've pulled back from these equal highs, you've produced a hammer candle on the Friday session. Let's get this, it's a little easier. There we go. Hammer on Friday. It's a bullish engulfer. It made a new low, but closed over the previous day's high. You know, a slower setup, just like that Chipotle chart, but over 98.50, you're probably looking at, look left, some thin structure retracement here. Again, as a swing trade, common shares, don't, back yourself into a corner with an options expiration, but generally over 98.50, 107.25, just shy of about 10 points in the upward direction here out of Starbucks. I mean, obviously that's very close to about a 10% move on something trading near 100. So there you have it. Starbucks is an idea for a longer term swing trade. And then finally, we've got Qualcomm in the semiconductor space, getting back to our bread and butter, technology names. This is probably more of a day trade, but if we can breach this 175, I think this just plays catch up to some of the other semiconductors here. We know that the SMH ETF is holding up just fine, so why not Qualcomm? This to the upside, and then this. So over 175 into 181.25, then 189.50 through some of this thin structure. Here it is on the hourly time frame chart. You can just see this very mild consolidation. Once again, it's a very slow moving chart. This is not something where I think, you need to back yourself into the wall with options. You could buy some longer dated options and try it that way, but even common shares on this, I think you got a nice little move potential here in the upward direction out of Qualcomm, and that is your third trade idea of today's episode. That's also going to do it for today's episode. If you enjoyed it or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. It goes a long way in terms of providing feedback. With that said, we of course will be live every day this week for our pre-market prep, kicking off at 8 o'clock Eastern time every morning, Monday through Friday, up here in the penthouse, with coffee and donuts on Thursday for our CPI inflation report. With that said, have a green trading week, and I will see you in the next one.